Analysis of active portfolio management, a summary. The first concept here is measuring value added. Value added is measured through active return. Active return is the return on a portfolio minus the return on a benchmark. Now, this is different from alpha. The alpha of a portfolio is the return on the portfolio minus the risk-adjusted return of the benchmark. The risk-adjusted return of the benchmark is the beta of the portfolio times the return on the benchmark. Also, we need to understand the concept of active weights. If a given portfolio has two securities, let's say we have one security that corresponds to stocks and the other which corresponds to bonds, and the benchmark has a 60% allocation to stocks and 40% allocation to bonds. The active portfolio has 70% in stocks and 30% in bonds. Then the active weight of stocks is plus 10% and the active weight in bonds is minus 10%. So that's what we mean when we say active weights. The active return can be expressed as follows. So this is another way of expressing active returns. Now let's work through some numbers. What is the active return for this particular active portfolio? If the benchmark is 60-40 and these are the ex-post returns on bonds, then the benchmark return is 14% stocks times the weight of stocks in the benchmark plus 2% return on bonds times the 40% allocation to bonds, and this gives us 9.2%. Now if we do the calculation for the active portfolio, instead of 60% we will use 70%, and instead of 40% we'll use 30%, and here we get 10.4%. So the active return is this minus this, which is 1.2%. But what if we want the contribution from each segment? So one segment is stocks, one segment is bonds. Then we use this expression. The active weight of stocks is 0.1 or 10%, and then the active return on stocks is equal to 14% minus 9.2%. And then the active weight of bonds, which is minus 0.1 into 2 minus the benchmark. So 2% is the return on bonds minus the benchmark return, which is 9.2. This particular component will give us 0.5%. So this is the active return coming because of the 10% overexposure or overweight that we are on stocks. And then the contribution from bonds, from the fact that we are underweight by 10%, so the active weight is minus 10%. Here the contribution is 0.7%, and when we add the two we get the same number, which is 1.2%. I've talked about the benchmark here, but what are the qualities of a good benchmark? The benchmark is a representative set of the assets from which the investor will select. Positions in the benchmark portfolio can actually be replicated at low cost. Benchmark weights are verifiable ex ante, and return data are timely ex post. In other words, once our investment period is done, it is quick and easy to get our return numbers. Decomposition of value added. So now we go one level deeper. Earlier we just said stocks and bonds, so we had two asset classes and we were looking at the return from each asset class. Now we are saying that value added can come from a combination of two sorts of decisions. One is the value added due to asset allocation, the other is the value added due to security selection. So let's understand this through an example. Say the strategic asset allocation is 60% stocks and 40% bonds, but an investor allocates 68% to this actively managed stock fund and 32% to this actively managed bond fund. So there are two active decisions that are made here. One active decision is to overweight stocks by 8% and underweight bonds by 32%. This is an active asset allocation decision, and this will turn out to be a good decision if bonds underperform and stocks do very well. The other decision is which particular set of stocks to invest in, and that decision is made by investing in one particular active fund. So this Fidelity fund is actually investing in particular stocks. It's not investing in the benchmark. Okay, now what's the value added due to security selection? If we look at the active stock fund, that generated a return of 35.3 versus the stock benchmark, which gave 32.3. So the active return from selecting particular stocks is 3%. As far as the bond fund is concerned, this gave a return of minus 1.9% relative to the benchmark return of minus 2. So here the active return is plus 0.1. Now, if we multiply these two numbers by the weights, so remember we had 68% in stocks and 32% in bonds, we multiply and add, and what we get is 2.1%. So the value added due to security selection is 2.1%. What about the value added due to asset allocation? Here we had a plus 8% active allocation to stocks. This needs to be multiplied by the benchmark return of 32.3, and then minus 8% active allocation to bonds. This needs to be multiplied by minus 2 because that's the benchmark return. When we add, we get 2.7%. So the overall active return is 2.7% plus 2.1%, which is 4.8%. The information ratio is the active return divided by the active risk. The active risk is the standard deviation of active returns. Now, this is essentially the active return per unit of active risk taken and looks a lot like the Sharpe ratio. The Sharpe ratio is the return on a portfolio minus the risk-free rate divided by the standard deviation of portfolio returns. So you can see the similarity here. The numerator for the information ratio is return on portfolio minus return on benchmark, and here we have return on portfolio minus the risk-free rate. So in essence, you can think of the risk-free rate as the benchmark here. And then with the information ratio, we divide by the standard deviation of the active return, and with the Sharpe ratio, we divide by the standard deviation of the portfolio returns. The ex-ante information ratio is a measure of expected active return and risk. So if you are at time 0, then we will come up with an expected or ex-ante information ratio. That would be the expected value for the active return divided by the active risk. Ex post measures the realized active risk and return. So if we get to the end of the period, then we will have a number for the active return. That number divided by the active risk will give us the ex post measure. The information ratio is affected by the addition of cash or leverage in a portfolio. Adding cash to a portfolio of risky assets will cause the information ratio to decrease. Now, this is where the information ratio is different from the Sharpe ratio. With the Sharpe ratio, adding cash or adding leverage does not change the Sharpe ratio. The information ratio of an unconstrained portfolio is unaffected by the aggressiveness of active weights. An unconstrained portfolio is one where there are no constraints. So if we need to take short positions, we can. If the active security weights are all multiplied by some constant C, the information ratio of an actively managed portfolio will remain unchanged. So the point is that if we include this factor of C that increases the active return and the active risk by the same amount, the C and C cancel out and we are back to the same information ratio. Constructing optimal portfolios. Now, in this context, an optimal portfolio is one which has the highest Sharpe ratio, and in this optimal portfolio, we combine the benchmark portfolio with an actively managed portfolio. the Sharpe ratio of this overall portfolio is going to be based on this expression. Next question is, what is the optimal amount of active risk? The optimal amount of active risk for an actively managed portfolio can be calculated using this expression. So if we know the Sharpe ratio of the benchmark, we multiply that by information ratio divided by the Sharpe ratio of the benchmark. So if we know the standard deviation of the benchmark, we take that as a starting point and multiply by information ratio divided by Sharpe ratio of the benchmark. So let's look at this question here. We have an actively managed portfolio with an information ratio of 0.3. So here the information ratio is 0.3. The benchmark has a Sharpe ratio of 0.4 and a total risk of 16%. So given these numbers, what is the optimal amount of active risk? Just plugging in the numbers, we have the standard deviation of benchmark returns, that's 16%. So this will be 16% multiplied by the information ratio of 0.3 divided by the Sharpe ratio of the benchmark, 0.4. So this gives us 12%. The optimal active risk is 12%, which is more than the active risk that is currently being taken. So this active risk is not the optimal amount. What is the optimal amount of aggressiveness? So aggressiveness is just measured by the active risk. We've calculated that this is 12%. What is the total risk of the portfolio assuming optimal active risk? So the total risk of this portfolio can be calculated using this expression. So this is equal to 16 squared plus 12 squared, and then to come up with the active risk we take the square root of this number, and that will give us 20%. Let's dig a little deeper now into active security returns. So if we want to get active returns, so these are realized active returns, we have to create a portfolio with active weights. If we don't have active weights and all the weights are equal to the weights in the benchmark, then obviously our return will be the same as the benchmark return and there is no active return. So we need to take active weights. But there are two things to worry about. Sometimes there are constraints because of which we cannot create a portfolio with the optimal amount of weights. So step one is figuring out the optimal amount of active weights, and that can be done using this expression. Here, this is the active return. The IC is the information coefficient. The BR stands for breadth, and these are terms that we will be discussing in more detail over the next few minutes. This sigma I is the active risk of each individual security, and mu I is the forecasted active return of each individual security. So we can come up with our optimal weights for all the securities in the active portfolio. This box here represents the forecasted active returns for each security in the portfolio, and we can calculate this as follows. The information coefficient times the volatility of that particular security times something called the score. The score is a number that tells us whether we expect the security to outperform or underperform. So if the score is +1, that means we expect the security to do well. If the score is a minus number, then we expect the security to not do so well. Now, the link between active weights and forecasted active returns is important. For securities where we expect or forecast high active returns, we should be able to have high active weights. And for securities where we expect negative active returns, there we should be able to have low or even negative active weights. Now, the ability to do that will be perfect in an unconstrained portfolio. But if we do have constraints, then the correlation between these two is going to be less than 1. That correlation is measured by something called the transfer coefficient. And again, to emphasize, if we have no constraints, then the transfer coefficient is going to be 1. The more the constraints, then the transfer coefficient is going to be less than 1. Now, the other important variable is the link between forecasted active returns and realized active returns. This is measured by the information coefficient, which is the correlation between risk-adjusted active returns, the realized active returns, and the risk-adjusted forecasted active returns. If this correlation is high, that means the information coefficient is high, and it says that the quality of active fund manager is very good. All right, now something that is extremely testable, which is the fundamental law. This is the fundamental law. It helps us predict the expected returns of an active portfolio. The expected active returns equal the transfer coefficient times the information coefficient times the square root of breadth times the active risk. Now, from this we can easily calculate the information ratio. So we simply take the active risk and bring it in the denominator. We will then have the information ratio. So that is equal to this expression. We've talked about the transfer coefficient. This is essentially a measure of how well we can create our actual portfolio. So it is the correlation between the risk-weighted forecasted returns and the active weights. For an unconstrained portfolio, this is going to be 1, and the higher the constraints, the less this number is going to be. The breadth of a portfolio is the number of independent uncorrelated decisions that are made. So if our portfolio has 4 stocks and we are making 4 independent decisions which are not correlated, then the breadth is going to be 4. The optimal amount of active risk is the transfer coefficient times this ratio times the standard deviation of the benchmark. Notice this is similar to something we've seen before, except we now multiply by the transfer coefficient. And the Sharpe ratio of our portfolio is given by this expression. This also looks like what we've seen before, but now we include the transfer coefficient. So let's work through a simple exercise now. An actively managed portfolio has a transfer coefficient of 0.5 and an unconstrained information ratio of 0.3. The information ratios used over here are unconstrained. The benchmark portfolio has a Sharpe ratio of 0.4 and a risk of 16%. What is the optimal amount of aggressiveness? So we come up with the optimal amount of aggressiveness using this expression. The transfer coefficient is 0.5 multiplied by the information ratio, so 0.3 divided by Sharpe ratio of the benchmark, which is 0.4 multiplied by the standard deviation of the benchmark, so that is 16%, and this will give us 6%. So 6% is the optimal amount of aggressiveness. If the actively managed portfolio is constructed with this amount of active risk, what is the Sharpe ratio? So now we can use this expression. We have the Sharpe ratio of the benchmark squared, which would be 0.4 squared, plus the transfer coefficient squared, that is 0.5 squared, times the information ratio squared, which is 0.3 squared. So if we do this calculation, we will come up with the Sharpe ratio of the portfolio squared, and then we can take the under root. If the constrained portfolio has an active risk of 8%, how can the active risk be lowered to the optimal level of 8%? So if this is our benchmark, this is our active portfolio, the benchmark has an active risk of 0, and our active portfolio has an active risk of 8%, but we want to be here at the 6% mark. So we combine the benchmark with the active portfolio. The weight of the active portfolio is 6 over 8, which is 75%, and the weight of the benchmark then will be 1 minus this number, which is 0.25%. Now, at times you might see this term, the basic fundamental law. If actively managed portfolios are constructed from optimal active weights, in other words, there are no constraints, then the transfer coefficient will be 1, and in all our expressions here, then this TC is 1, which means that the expected return simply is the information coefficient times the square root of breadth times the active risk. Whenever you see the star, that implies that we are using the optimal weights, and the information ratio then becomes this expression. Ex post performance measurement. Now this is the performance measurement after a given period. Actual performance is measured by the relationship between relative weights and realized active returns. The expected value added conditional on the realized information coefficient is termed IC, and R is for realized. That's given by this expression. The transfer coefficient times the realized information coefficient square root of breadth times active risk. Realized value added of an actively managed portfolio can be divided into two parts. The expected value added given the realized skill of the investor that period, that's given by this part of the expression, and any noise that results from constraints that impinge on the optimal portfolio structure. So that's given by this component. A portfolio's ex post active return variance can also be decomposed into two parts. One part is the variation due to the realized information coefficient, so that corresponds to this, and the other corresponds to variation due to constraint induced noise, and that corresponds to this. Applications of the fundamental law. We can have cross-sectional applications and time series applications. So an example of a cross-sectional application will be where we are choosing from a list of 100 stocks, and let's say that we are concerned with returns over a 1-year period. So at the start of that 1-year period, we make 100 decisions in terms of which stocks and what weights to use. And if all these decisions are independent and uncorrelated, then we say that the breadth of this strategy is equal to 100. And this is a cross-sectional application because we are making a decision at one point in time across 100 stocks. Now, the other scenario is a time series application. So a time series application would be where we make decisions over time. So if we have a 1-year period with 4 quarters and we are making a decision at the start of every quarter, so a decision here, 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 and here, and let's say that this decision has to do with whether we put our money in a mutual fund that tracks the S&P 500 or we put our money in T-bills. So in essence, what we are trying to do is time the market here. So we make that decision at time 0, then end of the quarter, we might again make a decision, and so on. So here we are making 1, 2, 3, 4 decisions, and these decisions are being made over time. So this is a time series application of the fundamental law. If our 4 decisions are independent and uncorrelated, then the breadth of this strategy is equal to 4. Now, sometimes these two might be combined in the sense that we might be making 4 decisions over time, and every time we are making a choice between, let's say, 10 securities. So we are deciding to take a position in 10 securities and we need to decide the 10 weights at each of these points in time. Then the breadth of the strategy, assuming that all our decisions are independent and uncorrelated, would be equal to 10 times 4, which is 40. Now, the curriculum talks about equity related strategies, fixed income related strategies. So if we are talking about picking stocks, then that would be equity strategy. If we are talking about picking bonds, then that would be a fixed income related strategy. Here is something that is emphasized in this segment of the curriculum. For unconstrained portfolios, the information ratio does not change with active risk. On the other hand, for constrained portfolios, the information ratio generally decreases as the active risk increases. So you need to remember this. The final point in this reading has to do with practical limitations of the fundamental law. The fundamental law ignores transaction costs and taxes. The fundamental law is based on mean variance optimization and hence has many of the same limitations. This segment of the curriculum, however, focuses on two limitations. The first is the information coefficient as an ex-ante measure of skill, and the second is the independence of investment decisions. In terms of the first one, the information coefficient as an ex-ante measurement of skill, sometimes investors overestimate their own skill, so this is a behavioral bias. Also, the forecasting ability varies across different asset segments. So if a particular manager is deciding on what weights to use on 500 stocks in the S&P 500, his expertise across all the different segments in here is not going to be the same. He might be more of an expert at picking technology stocks versus picking pharmaceutical stocks. But that distinction between the ability across different stocks is not properly captured in the information coefficient. The forecasting ability varies over time. So just because somebody has done a good job of forecasting in the past doesn't mean that the same ability will hold in the future. Security selection strategies have produced results which are 45% to 91% of original estimates using the fundamental law. So when we use the fundamental law, we predict a certain active return, but the actual active returns typically are much less than that. If uncertainty about forecasting ability is high, then the expected value added will be low. The second high-level point is related to the independence of investment decisions. We often assume that if a decision is being made about N securities, then N is roughly equal to the breadth. But this is not necessarily the case. N is not necessarily an adequate measure of breadth when active returns of individual assets are correlated. So if we are making a decision to overweight all stocks in a given industry, it is unreasonable to assume that all those decisions to overweight the stocks in a given industry are really uncorrelated. Chances are those decisions will have a high positive correlation. Also, bond returns tend to be highly correlated, so using the fundamental law in a bond context will be tricky. The examples that I've discussed here indicate that the breadth is actually going to be less than the number of securities. On the other hand, when we use hedging strategies, then it is possible that the breadth is larger than N.